Hello again to everyone, and I'd like to thank you for joining us today. And based on the overwhelming response we received to our governance session at this year's SBBN Roundtable, Capital Plus Exchange and the SME Finance Forum are proud to present the third in a series of webinars on good governance that answers many of the questions that were raised by bank CEOs at that event. This webinar is presented by the IFC's Bill Hayworth, an experienced strategist, risk manager, credit officer, portfolio manager, and financial services consultant with expertise in strategy, risk, cost reduction, organization design, and HR. Bill has lived in the Middle East, Asia, Australia, and the USA. He's worked in over 40 countries, including Brazil, Mexico, Russia, India, China, Indonesia, Vietnam, Cambodia, Saudi Arabia, Egypt, Australia, and the U.S. He possesses extensive experience in analyzing banks internationally and in developing and implementing performance improvement programs. He is currently on the Board of Commissioners of the Bank Andera in Indonesia, an apex bank specializing in lending to MFIs. He was FRM GARP certified in 2004 as well. If you have any technical problems during this session, I would ask that you please reach out to my colleague David Sheffick, either via email or Skype, and we do participate fully throughout the webinar. We'll be taking questions continuously via the chat box on the right-hand side of the screen or through the questions box as well. I'll read them aloud to the facilitator to respond to. And also, for a few individuals, if you'd like, during the discussion period, we will unmute your microphone so you can interact and speak with Bill directly and ask any questions that way. All of our webinars, including this one, will be made available on the website listed if you want to view it later or if you want to share it with any colleagues. So please feel free to do that. And Bill, if we could just move forward on the slides.
Sure. Can you hear me okay?
Yeah, we can hear you great.
All right. Good morning, good evening, good afternoon. I think people are all over different time zones. So thank you all for joining at whatever time it is where you are. It's 7 o'clock in the morning here in Washington, so it's still early. Let me move through these slides. We have quite a few slides, so I will move quickly through some, and if you have questions that we can cover in this session, that's great. If not, I'm happy to take email questions offline. So I'm not trying to figure out how to. So the first polling question that we wanted to ask, and I think you can vote on this on your machines, is who is primarily responsible for risk governance in any organization? And you have four choices: the board or board risk committee, the chief risk officer, or the CRO, the business lines, the people that are actually taking the risks, or the head of internal audit who's watching what's going on.
Great. So we're starting to see votes come in, so everyone should have a poll up on their screen. So please select one of these, and we'll wait about another 15 more seconds here. Just to have these answers come in. And we're going to close it in just about 5 seconds here. Okay, great. We're going to go ahead and close the poll. And overwhelmingly, I'm not sure if can you see the poll results, Bill? 74% for the board.
Okay, excellent. That is the answer I would have given, and I think risk governance is the key word in the question. If it's a governance question, it really is the board's responsibility. The CRO, the business lines, and the head of internal audit all have critical and important roles to play in risk management, but they are not responsible for the governance. The board is responsible for the governance. There are a few slides in here that you may see that have red triangles on them, and I'm just skipping them to save a little bit of time. I want to go back just so we are all on the same page when we talk about risk. And to simplify, I want to talk about basically 5 risks that a bank must manage. The first risk is the strategic risk, and that may be the most important because that's where you choose the markets that you're going to be in, the products that you're going to offer, the clients, the delivery channels, who you're going to compete with, how you're going to do it, and ultimately that drives your risk appetite statement, which is the statement that guides the kind of risk that you take as a bank. Once you've decided what your strategy is going to be, you then wind up taking credit, market, and operational risks in pursuit of the strategy. And when you take credit, market, and operational risks, you often wind up taking reputational risk. And I think most of the people on this what is this, a webinar, I guess, understand the credit, market, and operational risks. So I want to just stop for a second on reputational risk. We've seen a lot of reputational risk and a lot of cost associated with reputational risk in the last 5 years. And when we talk about reputational risk, we're talking about things like mis-selling or irresponsible finance. So that would be selling, in the U.S., the best example is subprime mortgages, where bankers sold mortgages to people who had no ability to pay those mortgages, and then packaged them up and sold them to investors in pools that had no understanding of what was in those pools. It was irresponsible on both ends. There are other problems of mis-selling that cause reputational risk. There are also, we've seen the most recent LIBOR crisis where banks have colluded to set foreign exchange prices in a way that makes their profits better, but is now undermining their reputation even further in the markets. We at IFC, we worry very much about environmental disaster risk because we do financing for infrastructure projects that can often take quite a lot of environmental risk, and we want to make sure that we evaluate that risk and are not associated with environmental disasters. That reputational risk often leads to the loss of trust and confidence, can lead to runs on the bank, and can lead to regulatory intervention. So when we think about reputational risk, it can be life-threatening to a bank, even more life-threatening than credit, market, or operational risk. But all those risks need to be governed and managed by the board. I think we need to think about the board's risk awareness. I personally have seen many people on many boards who are not very aware of the risks that the financial institutions take. And this goes to 2 questions, I think. One is the kind of people we select for the boards, and second, the kind of training and support that we give those people that we select to understand risks. So we put 3 basic questions on this page. One is the company taking the right risks? That question is easy to ask but hard to think about deeply because what is a right risk? Well, a right risk is one that you take where you make money on average, and in volatile markets you don't lose everything. That's the right kind of risk to take, one that is sustainable. Is the company taking the right amount of risk? Again, an easy question to ask, but implied in that question is the need to understand what the wrong amount of risk is. Normally we would define the wrong amount of risk as the risk that would threaten our capital base to the extent that we would have to go and raise more capital, or that would threaten us with bankruptcy or regulatory intervention. So in general, if a bank loses 20% of its capital, it can survive. If it loses 50% of its capital, it runs the risk of being intervened by the regulators and sold. So it's a terminal event for a bank if it loses half of its capital. So you would never want to take risk that put more than half of your capital at risk. Then the last question would be, is the company managing risk effectively? Because once you've made a loan or taken an asset position, that loan or asset position changes over time. The risk profile of that changes over time, and you need to understand those changes and what it's doing to the capital at risk. And so you need to manage it and make sure that your exposure is not getting out of control. If we think about integrated risk management, and this begins to sound like a consulting presentation, and the graphic is a little bit complicated, but basically what it's trying to show is that you have a business planning and objective setting process that is implemented, if you will, through a set of business processes. And in this case, we're talking about risk management, where we're identifying the risk and capturing it, measuring it, reporting it, and then controlling it. And those processes are supported by what on this slide we call infrastructure. The infrastructure consists of the policies and procedures that you put in place to make sure that the risks are measured the right way, reported the right way, and it also consists of the technology that you have in place to make sure that you're getting that information. Now, you don't need to have sophisticated technology. You could, I mean, I've seen banks in some countries that still use ledger books to record their loans. So it is possible to manage risks effectively without computers, although it is highly unusual today for banks to do that. But the level of sophistication of the technology is not as much the issue, in my mind, as understanding what I'm going to call the architecture of the risk reporting. So it's knowing where to go and get the data and how to pull it together. And if you do it manually on pieces of paper, or if you do it with relatively unsophisticated spreadsheets like Excel, or if you do it with very sophisticated computer systems, the point is that the information needs to flow from the right sources and be added together the right way. You can do it in any kind of technological environment, but you need to do it if you're running a bank. So the board needs to understand that in the particular bank that they are governing. Now, what's changed? There's been a huge shift in regulations since the financial crisis. The Basel Committee has been putting more and more pressure on banks to do a better job of risk governance and risk reporting. And I think if we think of the changes that we've seen over the last 5 years, number one is that people now talk about risk appetite and a risk appetite framework encompassing all of the risks. And out of that framework come a risk appetite statement. And one of the board's responsibilities is to make sure that they understand and agree with the framework and the risk appetite statement. So I think one of the board's primary responsibilities is to sign off on that. And again, that framework and statement come directly from the strategy that the board also will approve for the financial institution. Second is there's a very large focus on risk compliance, particularly recently on conduct risk. And by conduct risk, it means the way that the bank employees are actually behaving. And that conduct is things like selling subprime mortgages. Is that conduct condoned or by the bank? Is colluding to set foreign exchange rates condoned? So what is it that allows that kind of conduct to take place? Why isn't that governed the right way? And then there's adherence to policies and procedures and the ethical standards. Third is reputational risk. We've talked about that already. Fourth would be capital allocation, and that is measuring how much capital is at risk in your transactions and in your combined product sets. Fifth is risk culture. There's shifting accountability to the front office and line where the risk takes place, and asking, do we have the right culture for the people that are actually guiding the risk on a day-to-day basis with customers, and are we making sure that we don't have conduct risk in our sales force, for example. Sixth is stress testing. There's much more focus now on conducting systematic stress tests to see what would happen to the bank if a set of economic scenarios happened. So if there were a severe downturn, or if there was a big change in regulations, or if a certain industry had very severe problems, what would happen to the bank? There's a focus on the risk technology, the IT architecture, and the cybersecurity. We've seen many banks attacked by cyber criminals, hacking in, trying to get into accounts, stealing money, and a lot of it is not even publicized because I think the banks are so embarrassed by it and so worried about the confidence, a lack of confidence that would spawn if we really understood what was happening. And lastly is the operational risk, the risk that someone commits fraud in the bank, and then the fines that result from some of those frauds. Some of those fines have been really enormous. I think billions and billions of dollars. And so that's been sort of the focus over the last couple of years. If we look at what the Basel Committee has said in terms of corporate governance principles for banks, there are 8 principles, and I'm going to run through these very quickly and then discuss each one in a little bit more depth in the rest of the presentation. But the eight governance principles are that the board is responsible for risk governance. 1, establish and monitor business objectives and strategy. So that is, set the strategy that the bank is going to have. How is the bank going to make money? What kind of risk is it going to take to make money? And how is it going to manage that risk? Second is to establish the corporate culture and values, including the risk culture, the fairness and disclosure standards, the environmental and social responsibilities that the bank will have, the E&S standards that the bank will put in place, the code of conduct for bank officers, and so forth. So again, the idea being that you set up an organization that has a certain set of standards that they apply to the market. Are you fair to your customers? Are you transparent with your customers? Do you believe in responsible finance? 3 is to oversee the implementation of an appropriate governance framework. That includes the risk governance and levels of control. We'll talk more about that. 4th is to establish the bank's risk appetite and to approve the risk appetite statement and to monitor the adherence to that appetite statement at least quarterly. 5th is to establish the effective risk management organization and to ensure appropriate staffing. So it's not a matter of just having the right boxes, it's also having the right people in the right boxes. 6th is to approve and monitor capital adequacy, liquidity, and compliance to internal controls. And of course, capital adequacy is a deeply philosophical concept because you have to ask adequate for what, and when you ask that question, you begin to say it's adequate for, is it the worst case on the stress tests, or the unimaginable case, or the case that's most likely in a bad time? It's a hard question for the board to grapple with, but capital adequacy is, of course, what enables a bank to survive in unexpected bad times. 7, select and monitor the senior management, maintain succession plans and staff board committees with appropriate experts. And 8 is to design and implement incentive systems and reinforce good risk management. And that last point, I think, is 7 and 8 taken together. One of the biggest problems we've seen historically is that the managers of banks know a lot more about day-to-day banking and how to take risks and how to make money than the board does. So inherently, it's very hard for the board to govern the management of a bank. We've seen it's very, very difficult to do. And the managers of banks tend to try to make themselves wealthy through their activities in the bank. Some of those incentives are very good because it makes the shareholders rich and it doesn't take too much risk, and the bank can survive and prosper under that kind of management. But sometimes the managers take risks today that don't actually affect the bank for several years, and they take big bonuses today, and the risks come home to hurt the bank in several years, and by then the managers have taken the money out of the bank and are happy that they don't have to bear that risk. The board's job is to make sure that those kinds of things don't happen. The board has to be very aware of the inherent conflict between managers and shareholders, and to be clear whose interests they serve, and that is often a problem, and it is the most central problem to governance of banks, really. And we've seen cases where some board members made as much money as managers did in taking their board governance roles and driving risk into the institution and taking huge amounts of money out of it in current years when future years bore all the losses. So the intertemporal justice of the compensation system simply didn't function. And that's something the boards need to worry about. It's certainly something that regulators are now worried about. So when we think about business objectives and strategy, I'm going to go quickly through a number of these slides. Ultimately the board needs to choose the business that the bank is in, needs to understand the kinds of risks that are associated with the businesses that the bank is in, and how that concentration on certain lines of business affects the risk and the diversification of the bank. And I'll move again quickly through some of this. The board needs to establish the corporate culture and values, the risk culture, if you will, and that it defines not only how risks are taken, but how customers are treated, the level of transparency, whether the bank believes in responsible finance, and so on. So it's those norms and traditions and behaviors of individuals and groups within an organization, right? And that's something the board has to stand up and believe in. And it has a lot to do with business ethics. When we think about risk culture, the way to think about it is, I'll use the blue boxes on the right. It's a set of common values. We believe in responsible finance. We believe in telling people what the real cost of a transaction is. It's the tone from the top. It's having a common risk language so that when we talk about capital at risk, we understand what capital is. It's the application of risk management principles. That we will measure the risk in each transaction, that we will look at the effects of concentrations and diversification. It's the timely, transparent, and honest communication of risks as they change. It's the assignment of risk management responsibilities, and it's the ability to engage in challenging discussions on risk matters. And that often means accepting dissenting points of view and really exploring those dissenting points of view. And part of this whole discussion, I think, can come through processes like stress testing, because in the stress testing exercise, you're basically asking questions like, what's the worst thing that could happen? And it forces you to think about what's the worst thing that could happen and how likely that is to happen and what the impact of that event might be on your capital, and then what kind of problem that would cause you, and what sort of planning you need to do in the event that something like that actually materialized. Right, so culture, I'm going to skip this page, but I think the questions on this page really go to what kind of culture the bank has. Is it a culture that has the interests of the customer at heart, or is it one that is trying to make as much money as possible in the short term as you can in order to pump up the bonus pool this year and not worry about the future? And that's a culture that an institution can establish either way. In the risk governance framework, I think the issues that you need to really worry about and that the board needs to think deeply about are, first, how do you measure exposures? It's pretty easy to measure a single borrower exposure. It gets much more complicated in many markets to measure group exposures because often in groups, the head of the group can move money around in group companies at will. And so what is shown on the financial statements is a proxy for what exists today, but it doesn't guarantee that that's going to exist in the future. And even with cross guarantees and legal agreements, you still can't really control the cash flows inside a group very effectively unless you actually have the money in your account or some collateral. And so thinking about what that exposure to groups looks like is very important if you have large exposures to those groups. Also, thinking about the sectors where you're taking the risk. If you have a very large exposure in agribusiness, for example, or in the case of Bank Andara, where I was on the board, we had all of our exposure was in effect to a regional microfinance business that existed only because of a single regulation in the central bank. So we had tremendous stroke of the pen risk to our main business segment. So we would think, how do we diversify out of that business segment into other segments so we can insulate ourselves from potential regulatory change? And that kind of thinking about the geographies where our risk is taking place. Do we want it all centered in one geography? In a small bank in a small country, you don't have a lot of choice about the geography, and you need to begin to think about other ways of diversifying. Same questions with currencies, same questions with the tenor of risk you're taking. Is it all short-term? Is it all long-term? Can you balance the tenor of your risks and the tenor of the loans and the tenor of the deposits and so forth? So those are the things that I think the board needs to really focus on and sort of dig into. And then also how we limit exposures to determine what a tolerable unexpected loss would be. Now, I think most of you are familiar with the sort of risk speak, I'll call it, where we talk about expected losses and unexpected losses. But just for review, an expected loss is the loss that you expect normally in the business. So in a credit card portfolio, you might expect to have a 5% credit loss rate, for example. That's the expected loss. You expect to lose that every year, and you build that into the structure of the product, and you price around it so that you make money. An unexpected loss is a loss that you could experience, so it's not really unexpected. It's just an unusual loss. It's a loss that you might have during a severe business downturn. So in a severe recession, for example, credit card losses might rise to 25%. So the expected loss is 5%, but the unexpected loss might be 25%. So you would need to have enough capital set aside to maintain that 25% loss in your credit card portfolio. And that's sort of the way we think about the capital at risk and the percent of exposure, and that's the way we set our capital cushions, and that's the way we need to think about each product, and then we need to add it all together and think about the portfolio effects that each of those products has when taken all together. Are there offsetting gains and losses, or do all of the losses run together and sink us faster? And the purpose of stress testing is to really think through before the fact what would happen if some of these unexpected events occurred. So thinking through what would happen if we had a severe recession and so forth. So in IFC we do stress tests, and we assume things like, well, what if 3 countries where we have large exposure all went through severe financial crises at once? And so we might say, what would happen if Russia had a problem? Well, guess what? They do right now. What would happen if China had an economic downturn at the same time? And what would happen if Brazil had an economic downturn at the same time that Russia and China had a downturn? What would happen to IFC's balance sheet? And what does that tell us about what we would want to do to manage it? So that's part of the stress test discussion. In small banks, that it's not going to be country exposure, it's going to be sector exposure, or perhaps the tenor, or perhaps the product like mortgages that you're going to be concerned about. And then out of that discussion, I think there will be what I call setting up the risk acceptance criteria, and that's what do you want to see in terms of the criteria that you would expect before you would make a loan to a company or before you would take a risk, and that is things like the number of years in business, what sectors are excluded, where won't you take risk because the environmental risk might be too high or the credit risk might be too high. What kind of ratios would you expect to see in a given industry, the leverage ratio, the liquidity, the profitability? What kind of collateral would be required by product? What kind of collateral coverage would you expect to have, and so on. So all that comes out of this risk governance framework, and you sort of start with the framework and you work all the way down to the product level. And we talked already about reputational risk and a bit about technology, and so I won't go into that right now. I will make one comment on how we organize to manage risks. And there, again, I think it's important to think about the separation of duties and creating what I'll call a positive adversarial structure. You want people to be arguing about risk. You want different points of view in order to have informed judgment. And so you want a structure that gets people talking about risks that are being taken by the organization. And I think that's critical as you think about the organization design, and I think it's critical for boards to get more than one point of view about risks. I think dissent is a very healthy thing in a risk management culture. So here's another polling question. An effective risk governance framework, A, identifies risky activities and prohibits the organization from engaging in them. B, identifies risky activities and recommends strategy for managing and monitoring them. C, is responsible for risk monitoring and crisis management. D, is responsible for stress testing and scenario planning.
Great. So we've gone ahead and opened the poll, and please note we shortened some of the words here. So identified risky activities and prohibits organizations from engaging in them. Identified risky activities and recommending strategies to manage and monitor are the first two. So let's keep the poll open now for another 15 seconds. And so please go ahead and put in your answer, and you can only choose one. And we're seeing some responses coming in, and we'll keep it open for about 5 more seconds. And we will go ahead and close the poll at this point in time. And 94% chose the second answer, identifying risky activities and recommends strategies to manage and monitor.
Great. That's the answer that I would have chosen, although I hate multiple choice tests, and I think that C and D are subsets of B. So anybody that chose C or D gets partial credit. So I think that's a very good result. Jessica, are there any questions that that people would like to ask at this point, or
we have had a couple questions coming in, and I'm not sure which of these you want to answer now. Some of these I think are going to be a little bit longer, but in terms of the first steps in implementing good governance for a small institution, what are the first steps to do that, and then really who should take the lead at the board level? Is it the CEO? Is it the board chair? Or another person? So we may want to leave that one to the end. And then we just had a question come in terms of any examples of stress testing scenarios that you can share. So any sample stress testing scenarios.
Yeah, on the I'll answer the stress testing scenario question. Usually what a bank will do is they will take an economic scenario, and usually they'll take 3 economic scenarios, and they'll assume that things continue as is. They'll assume that things get a little bit worse, and then they'll assume that things get severely worse. And the question you have to ask is, how do you decide what severely worse looks like? Some banks take the worst historical experience, so they look back and they say, what's the worst thing that's ever happened? So in the U.S., when I was doing some stress testing a few years ago, we took the Great Depression as an example of the worst downturn that we'd experienced, and we said, what happens if that happens again? What would happen to the business, and what would it mean for what we should do? Other companies, depending on the kind of business that you're in and the kind of risk exposure you have, some countries are highly exposed to oil price fluctuations. So if I were working in Saudi Arabia again, one of the things that I would look at in my stress tests would be the oil price. So if I assume that oil went to, say, $50 a barrel, what would happen to the business in Saudi Arabia? We know that would cause a severe downturn, and what would the impact be on local businesses, and what would that do to the bank's balance sheet, as an example. Or if you're in a country that is highly dependent on exports, you would want to look at the export sectors and ask yourself, if there was a downturn in our main export markets, what would happen to the businesses that are in those exporting industries, and what would happen to the people in the supply chain to all of those exporters? How does it carry through the economy, and what would we expect to see in terms of declines in sales, declines in profitability, stress on the capital of the companies in our portfolio, and what would that mean to our non-performing loan ratios and our credit loss rates? Questions like that. Questions like, what would happen if our country's currency declined by 30% or 40%? Whatever numbers you decide are sort of worst case but plausible. So questions like that. Let me run through some of these other slides quickly. I think one of the most difficult issues in risk governance is to answer the question, how much risk concentration should we allow? And again, it goes to those questions of trying to understand how risks behave in stress tests, because when times are good, everything looks good, but when times turn bad and when you've got economic downturns, you find out that many industries go down together. So you may think that the automotive industry is very different than consumer products, but the fact is, when you've got a recession, the automotive industry and consumer products industries both suffer, and they both have severe declines because of the overall economic impact. some industries are not as susceptible to those kinds of recessionary forces, right? So some consumer goods like toothpaste, you need toothpaste, people continue to buy toothpaste even when times are bad. It doesn't have very much impact. So the toothpaste makers often do okay. It's a fairly stable business. But it's thinking about how various businesses relate and thinking about the covariance of business performance and what that means for your non-performing loans and your credit losses in your scenarios and stress testing. All right, so when we switch to risk management organization, we think of 3 lines of defense, in effect, that the board needs to put in place. The first line of defense is the business line operations. These are the experienced credit people that are making the loans on a day-to-day basis. And these are the people that are saying, you know, this is a good credit, this is a bad credit, that are able to discriminate between good credit risk and bad credit risk. They're able to understand whether they're going to make enough money on a given transaction, and that are doing the business on a day-to-day basis. The second line of defense is your risk management organization and your chief risk officer. Those are the people that are giving you a second pair of eyes on the transactions, that are looking at what's happening, at least in aggregate, and making decisions about what's happened, making recommendations about what's happening at the portfolio level, looking at risk concentrations, looking at what goes wrong and adjusting policy to make sure that you don't continue to make the same mistake, and so on. And then the third line of defense is the internal audit function, and basically the internal auditors are tasked with reviewing the way that the business line operations are applying the policies and procedures and how that process is working. So when I was with Citibank, for example, we had something called the risk asset review function. And the risk asset review teams would go from country to country and evaluate the business line operations about the way that they were applying the Citibank credit policy. So they would look at the loan files, they would make judgments about the way that those loans were being made, they would make judgments about whether the credit policy was being applied consistently, and they would look at the way that the loans were classified according to risk. And in Citigroup, if in those days, this is a long time ago now, in those days, if a credit officer misclassified the credit risk of one of his borrowers, that meant that he would not get a salary increase that year. If he misclassified it by two risk classes, so we had a 5 risk class, if he said it was a 1 and it was really a 3, he was fired on the spot. So in Citigroup, it was okay to have risk, but it was not okay to disclose that you had the risk. So disclosure was part of the culture in that bank when I was there. That culture changed a lot, and I don't think that was true 5 years ago when they confronted all the problems that they had. But the 3 lines of defense were sort of tied together so that there was an evaluation process that looked at what the business line was doing, looked at how the policies and procedures were being applied, looked at the portfolio that came out of that, and then asked that reflexive question. So given that these policies have produced this portfolio, are these policies doing what we want them to do? And that's a question that the board should be asking. Is this whole control structure working in the way that we want it to work? So the circle tries to show how those things feed together, where the business lines go in and are assessed by the risk function, which are assessed by the board, which then change the way that the business operations operate. In terms of the risk governance organization, I think this gives just a very brief overview that basically you've got your business units, starting at the bottom of this chart, your business units and your risk management reporting, your risk management department, and then you have the chief risk officer as part of your executive level risk committee, all reporting into senior management. And the chief risk officer is usually part of senior management. But then separate from senior management, you have the board's risk management committee and the board's audit committee, and you have the internal auditor reporting directly to the board. So you have, the board has control outside of senior management, so they've got an independent view of what's happening. When I think about the things that make board be effective risk governors, I came up with 8 things. And I'm going to run through these very quickly. First is avoid concentrations of power, separate the chairman and CEO, and have a majority of independent directors. Again, the discussion of risk is critical, and so having independent points of view about risks, informed independent points of view is really important. Bring balance of required risk expertise to the boards and committees. So you need people that understand credit risk and market risk and reputational risk and so on. Set out a clear terms of reference and term limits for board members and committee members. It's not healthy to have somebody stay on the board for 20 to 30 years. Annually approve the bank strategy, the capital plan, and the risk appetite framework. Actively oversee and manage implementation of the risk appetite framework and insist on stress testing so that you can run through various scenarios. The stress testing is really just a thinking process, and it's part of the risk thinking process. Ensure that audit and risk committees have overlap and communicate with each other. Meet with regulators and other authorities to understand the way that they're viewing risk and ask them about best practices and ask them about the market risks that they see. And then engage independent parties to review the board performance every 3 years. So take a look at how the board is actually doing. In the same way that the board should be reviewing management, the board should be reviewing themselves independently to look for ways to improve. Again, I'm going to move quickly through some of these. Just the difference between the risk management committee and the audit committee, basically, very quickly, the audit committee is looking backwards, looking at how policies and procedures are being applied and what the adherence level is and what issues might be coming out of that. The risk management committee is more forward-looking, asking more hypothetical questions about what would happen if, and answering those kinds of questions and thinking about what that means for the kinds of policies that the bank should put in place, that the audit committee should confirm that are being enforced. So the board also needs to monitor capital adequacy, liquidity, compliance, and internal controls, and they do that through a series of reports that they get and through the internal audit function that confirms that the information that they're getting is in fact correct. So they need to approve the provisions by product and the capital weights for each product by business line. And this gets a little bit granular, and some boards are not comfortable with this, but fundamentally somebody on the board, at least the risk committee, needs to look at this in detail and make sure that the capital weights are correct, that the unexpected losses in those capital weights make sense. And the board has to understand that, and the board also has to understand the liquidity of the bank and what kind of events could threaten the liquidity and what alternative sources of liquidity they would have available other than the central bank in the event of a problem. 7, we need to select and monitor senior management, maintain succession plans, staff board committees with appropriate experts. Now, the board, probably the board's most important decisions are selecting senior management. And it's amazing how frequently CEOs turn over in companies and in banks. The rock star CEOs that we hear about are long survivors. but that's not the normal CEO. The normal CEO lasts about 18 months. So if you think of a bell curve of tenors of CEOs, the average is probably 18 months, and you've got a tail on one end where CEOs survive for 5 or 10 years, and then a number of cases where CEOs survive 3 or 4 months. So the board has to be always actively thinking about who the next CEO might be, and asking the question, what happens if, right? If there's a performance problem, if the CEO gets sick, we have to make sure that the bank has good leadership. Secondly, there needs to be a succession plan, and the succession plan could be somebody internally, or it could be that you know that you would have to go externally and go through a hiring process, which means that you'll be without a CEO for 6 to 12 months. Excuse me. And you need a plan to cover the 6 to 12 months. I was doing some work with Australia New Zealand Bank, ANZ, many years ago when they decided to replace the CEO. And it was done rather abruptly in a board meeting where the board just basically lost faith in the CEO that was in place. And they had no succession plan, so the chairman of the bank stepped in and became the CEO for about 9 months until they were able to recruit a replacement from Standard Chartered. But that process was very tumultuous for the bank, and it was a very difficult time to manage through, and the chairman was under a huge amount of stress because he was the chairman of several companies and also the CEO of one of the largest banks in Australia. So thinking about those issues becomes very, very critical. And the last point is to design and implement the incentive systems that reinforce good risk management. We've talked a little bit about this, and so I won't go into it. And I think actually I'll stop here and take questions. There are key questions that we can have. Yeah.
Yeah, we've had a couple questions come in, and so this is the point in time that we have the discussion session open, and you have the choice. You can either post your question within the question box, or if you'd like, I can unmute your microphone to ask a question directly. And we actually have Shidma from Hasbank in Mongolia. Shidma, can you hear us?
Yes, yes.
Wonderful. And Ashidma works directly in governance, and we asked her to share a little bit about her experience in this area, and if you had any other specific comments in relation to risk governance as well.
Well, thank you, Bill. It was very interesting. And we at Hasbank, we do have, basically we have in place almost all of the things that were described by Bill, and certainly our board is the most important governing body in risk governance. We have a risk management committee at the board level, and we also have a risk management committee at the management level. So we have a very good reporting system to the board, and we have fairly good policies and procedures in place for risk management. But I would like to say that one of the most important things, and maybe one of the specific things at Hasbank, will be to have a very an appropriate mix of local and foreign expat directors in our board composition, because Hasbank has a very diverse shareholding structure. We have foreign investors, we have local investors, and so it's very important to have the right people in our board, the people who have a very good understanding of not only risk management, but of risk management in a country like Mongolia, who board directors who have a very good knowledge of the local market. And so this is very important, and I think that our board is doing a very good job. Certainly there are a lot of challenges, but in our country we do have a crisis, and not everything is good. And just very recently the board was able to review the strategy, and strategy revisions also were followed by some adjustment in our risk appetite, in our risk management. And so strategy and risk management, they come together. So our board had a very good response, and we had a very series of different risk tests, and we were able to adjust our budget. And so this is also good. I think that, and our board was able to also do some changes in our management to respond to the changed risk appetites and strategies. So basically, this is, I think, what we do at Hasbank. And I'll be glad to answer specific questions about Hasbank.
Right, thank you.
Right.
Thanks so much, Ashidma. We really appreciate you sharing. We've had a couple other questions come in, and so I will pose these to Bill. And one of the first ones is in terms of risk governance after high delinquency. And so, what is the best way to establish a risk governance framework after there have been some delinquency issues at a financial institution?
That's a very good question, and I guess what happens after you've had high delinquencies is everybody gets scared, and you become ultra conservative. And you tend to not take enough risk. So the pendulum goes from taking too much risk and not worrying so much about it to taking too little risk and worrying too much about it. And it takes a huge amount of intellectual discipline to try and find the right balance after you've had high delinquencies in your portfolio. I think the best thing that I could recommend is that you look at the source of those delinquencies and you drill down and understand what mistakes were made that caused the delinquencies. Sometimes there are mistakes that can be corrected. Sometimes the delinquencies were caused by changes in economic conditions that were in effect unforeseeable, and you need to understand what caused those delinquencies and correct the problems that caused the delinquencies, but continue to lend and continue to grow the bank. And as I say, it's very, very hard to do after a period of delinquency because you're nervous and you're very scared, and collectively often the board is reluctant to allow management to take on additional risk.
Great, thank you so much. And we've had a couple further questions coming in terms of the different roles of team members. So one of the first questions, as I mentioned, who should be the first person to take the lead on the board level, whether or not it's the CEO or the board chair, and then who is responsible for the failure of when a certain risk fails, for example. So just kind of talking about the different roles and responsibilities for the board and senior management.
Okay. And my flippant answer is to who should take the lead is somebody. In an organizational structure sense, the chairman should take the lead, but sometimes the chairman is a political position and maybe doesn't have the risk background and maybe doesn't know exactly how to take the lead on this. In that case, I would hope that another director would step up and take the lead and convince the chairman that they should be, made the head of the risk committee and so on. But somehow the board has to have somebody designated to take the lead on this. You would hope the chairman would understand that and would work to designate either himself or someone else to take the lead. But if the chairman doesn't exhibit that kind of leadership, then another member of the board needs to do that. And I would say that as an investor in banks, IFC would be encouraging the boards of the banks that we invest in to make sure somebody is appointed as the head of the risk committee, and that we would be working with that head of the risk committee to make sure that they're playing this role. In terms of who is responsible for failure, it's a very good question, and it's a hard question to answer. But ultimately, collectively, the board is responsible for failure, and they have to wear that failure, and they have tools to prevent the failure. Those tools consist of the ability to set the strategy, the ability to set the policies and procedures, the ability to appoint the people to manage and implement the risk strategies that they put in place, the ability to track what's actually happening through the internal audit process. So if this whole risk governance process is working, clearly the board is responsible. If the risk governance process is not working, clearly the board is responsible. So I think in the end, the board's responsible to make sure that this stuff happens and it works. Now, some people will say, well, there was a fraud inside the bank that the internal auditors didn't detect, and someone got away with it, and okay, those things happen, and it is possible for clever, unscrupulous people to defraud very dedicated boards. It is possible for that to happen. So in those cases, who's responsible? I don't know what to answer. But I would say that we understand how financial institutions work. We understand human beings. We know that financial institutions are always subject to fraud. We know we are always dealing with a lot of money that can be misappropriated, so we have to have controls in place that we can hold up and say, this is what we did, and if we missed it, this is what we did. And it needs to be objectively verifiable that what was done was reasonable and appropriate. And that's the board's responsibility.
Great, thank you. We had a question in terms of organizing a risk management department in a smaller institution or maybe a microfinance institution. So how should a risk management department be organized, and also who should be responsible for the risk asset review, the internal audit or a risk management department? So I think there's some questions in terms of what are sort of the roles of maybe an audit department versus a risk department.
Right. Right. And I think there are several ways you can approach it. Let me talk about the risk asset review question for a minute. One of the things that I saw in Citibank in the old days that I thought was very effective is that the risk asset review function was effectively a separate internal audit department. It was separated from the business line, so it was really part of the risk review function. And the internal audit function worked with the risk asset review teams. The way that Citigroup staffed the risk asset review teams was by taking experienced credit officers from one market and using them to review the loans made in another market. So, for example, I was working in Saudi Arabia, and I was sent to Egypt to review the loan portfolio in Egypt. and to look at that loan portfolio. Then later I did loan portfolio reviews in New Zealand when the Bank of New Zealand had their problems, and we put together an independent team of reviewers to look at that loan portfolio. Similarly at the State Bank of Victoria when they had their problems. So those teams can be drawn from multiple sources, and as long as they are independent. And the independence is the critical thing. So you don't have friends reviewing friends' loan files. And in terms of the organization of the sort of the risk function in a small bank, I think you want to have, and there are different ways of doing this. You can have a risk function that is part of the approval process, in the sense that the business development people are tasked with originating loans, and they are rewarded for originating loans. The risk review people are tasked with evaluating those loans, and they are evaluated and rewarded on the number of loans that go bad. So that their job is to keep the portfolio only full of good loans. The alternate way to do that is to let the business people have full responsibility for taking the risk, and the risk review people only make sure they're following policies and procedures. They don't approve the risks. They look at it after the fact. And that's a fundamental decision that you need to make as you design the organization, whether the risk people are involved in each transaction in a pure risk function, judging the transaction from a risk perspective, or whether they are involved after the transaction has occurred, judging whether the transaction occurred appropriately in the risk policies and procedures of the bank. You can do it either way, as long as you set the incentives correctly for the business people and the risk people. The tricky part of that is you need to make sure that the business people are incented, intertemporally incented, and by that I mean that they are not incented to take a lot of risk today to get big bonuses for risks that ultimately cause losses to the bank in a year or two. And that can be hard to do. Because it's hard to do, a lot of banks embed the risk review process in the transaction. And they say we want an independent risk evaluation of each transaction by someone who is only tasked with making sure we don't take too much risk. They're not tasked with originating business, and if the deal is turned down, they don't care. And it creates an adversarial process to approve each loan. So it's a matter of choice and what you think works best in your particular market.
Great.
I hope that answers the question.
Yes, I think it does. And two more quick questions. Who is responsible to maintain the risk register, and are there any standards in setting liquidity limits? I'm
not sure I know what the risk register is, but if that is the way that capital is evaluated by risk, I think that ultimately the board has to approve the capital weights for each type of product and transaction. And the policy for the capital weights needs to be monitored, and adherence needs to be ensured by the chief risk officer. So every transaction that the business team would put on the books would be evaluated by the risk department, and a capital weight would be assigned to that transaction, and that would tell you, basically how much risk the bank had taken on that transaction. And then the risk department would be responsible for adding up those transactions and looking at risk concentrations and thinking about how to evaluate concentrations. Again, whether certainly if it's a single borrower, a group, a sector, or an industry, a geography, susceptible to commodity price risk and so on. Thinking about each level of risk that could be involved in each individual and group of transactions that the bank engages in. Would be a chief risk officer function. What was the other part of that question? It was
liquidity
yeah.
limits. Yes, setting any standards and setting liquidity limits.
There is new thinking on liquidity limits that the Basel Committee has just put in place, and they've now said that any systemically important bank must have enough liquidity to cover basically 1 year of operations. Is the way that it's done. I cannot remember off the top of my head how that ratio was calculated, but we can certainly supply the Basel directive for the calculation of that liquidity ratio to anybody that wants it. It's publicly available on the Basel website, and I can send copies to people if you're interested. But it basically is a measure of the liabilities of the bank next year and the liquid assets that the bank has to cover those liabilities over the next year. And the Basel objective is to make sure that the bank has enough liquid assets to cover all of the liquid liabilities plus a bit over the next 12 months under almost any scenario. And the bigger and more systemically important the bank is, the more rigorous the calculation of that liquidity coverage ratio becomes.
Great. And we'll take our final question. And if you have any other questions or comments, or if there are any of the pieces that Bill mentioned that you'd like access to, please go ahead and post in the question or chat box, and we'd be happy to send you over any of those details. And so for our final question, what is the appropriate balance of effort for the risk committee or the CRO between risk monitoring and issue identification and then identifying solutions to these risks?
That's a great question, and I think like any question about balance, it obviously depends on where you are in the economic cycle. I think in good times the focus should be on the monitoring and the stress testing, and the stress testing, monitoring and the stress testing should be taking a big chunk of the time, so that you know what the downside risk is for the bank, and then in those good times, as you look at those stress tests, you should be spending maybe 20% or 30% of your time thinking about the solutions that you would have in place in the event that the adverse scenarios in the stress tests came to pass. In difficult times, I think what you're going to find is that the situation is bad, and it's not so much monitoring you're focused on, but the fact that things are deteriorating very rapidly, and you need to be focused on solutions immediately. So in an economic crisis or a bad recession in a country, you're going to be probably 80% focused on solutions to problems that are popping up in the portfolio. So I think that balance changes as the economic crisis situation changes, and you need to be ready to move and sort of change your field position in your game as times get bad.
Great. Wonderful. Well, Bill, we'd like to thank you so much, and we went a few minutes over, so we appreciate your time, but we had almost everyone stay on the call for it, so I think it was a very good discussion session. And I'd also like to mention that the extra slides and the appendix slides will all be available in what we send out to the participants next week, so you will have access to the entire slide deck. And with that, I'd like to thank everyone again for joining, and I hope you have a great rest of your day. Thank you so much.
Great. Thank you very much, and thank you for joining and for listening to me. Thank you. Bye.